Hey everyone, welcome back to Corporate Decoder. Today we are diving into the financial report of Cenntro, and let's just say their numbers tell a story of a company trying to steer through a storm. We'll see if they manage to keep the lights on or if they're running on fumes. If you are interested in the stock market, make sure to join our Discord to discuss it more. The link is in the description. In this video, we're decoding Centro's latest 10Q filing for the first 3 months of 2025. Cenntro is a company that designs and makes electric commercial vehicles, those EVs you see doing deliveries. This report gives us a peek under the hood at how they're doing financially, what challenges they're facing, and what their plans are for the future. Let's start with the big picture on their income statement. Cenntro reported a net loss of about $5.7 million. That's definitely not the direction they wanted, but a little better than the nearly $9.2 million loss from the same period last year. It means that while they're still losing money, they're losing less of it. For each share of stock, this shakes out to a loss of 18 cents per share, improved from 30 cents loss per share in 2024. There's 30,866,614 average shares used to calculate that number. Moving on to revenue, it was a mixed bag. Cenntro brought in about $2 MIC in revenue, slightly down from $2.30 in, hence the company might be struggling with sales momentum. Their cost of goods sold, the direct cost of making their vehicles, also decreased, coming in at $1.8 million versus $2.1 million, improving gross profit slightly. With revenue slightly down and cost of goods a bit lower, their gross profit, the money left after paying for the manufacturing of its vehicles, increased about 90% to around $320,000. Looking at the expenses of running the business, things get intra-spent. About $6.5 million on operating expenses. That's less than the $8 million spent on the same period of last year. They improved spending on things like running the operations by about 20%. This is definitely a good sign, as it suggests the management team is actively doing something about the cost structure of the business. Digging a bit deeper into the numbers, and what we find is that while core operation isn't profitable and relies mostly on investments, we will scroll to take a quick look at some key assets. Let's take a look at the asset position with a scroll to cash and cash equivalents. This is often a critical number for any company. What we see is $845 million of cash on hand, a big difference from $12.5 million in $24. And looking at inventories, which would be the cars and components they plan to sell, that's at $25.3 million, which has increased slightly from $24 million on December. Switching over to the liability side and scrolling to accounts payable, we see $4.88 money dollars at the end of last year. So the company is managing to decrease the short-term debt obligations. The company reports 237,296 N in short-term loans, nearly the same compared to 3 months ago. Let's look at a longer-term item with a scroll to deferred tax liabilities. They come in at about 166,000, barely changed compared to end of last year. This is a liability but also a financial tool, so keeping it close to last year's number is good. But let's focus on one liability, scrolling to derivative liability investor warrant. And what do we find but $12.1 million? That's money tied to things that aren't normal business, potentially risky things. And they have a second source of derivative liability. Scrolling a bit further down to derivative liability relating to placement agent warrants. Also over $3.4 million due from warrants. These warrants enable people to buy the stock at a certain price, potentially diluting their stock if they do. Speaking of liabilities, let's look at operating leases with a scroll to operating lease liability non-current. What we find is $7 in owed million of such non-current debt obligations. You can see the breakdown in operating lease weighted average remaining lease term 1, which is about 4 years for the remaining lease term. If we scroll all the way down to the balance sheet and the accounting equation, we can see the total liabilities are about $55 million. Now, it's also worth mentioning that the company has restructured operations in Europe by cutting back on their direct sales model, which resulted in a loss from discontinued operations, which means their European operations are underperforming. One thing that hasn't changed much is share-based compensation. Scrolling to share-based compensation, they still use that a lot. as is common in many companies nowadays. That costs around 740,000 during the quarter, 1,000 during the quarter, 1,000 during the quarter, 1,000 during the quarter. It's a way to pay employees without directly using cash, but it can dilute existing shareholders. Another thing that jumps out are the accounting policies that involve management estimates. These relate to everything from inventory values to potential credit losses to valuations of those tricky derivative liabilities. And if we scroll to significant accounting policies text block, we can see that if management makes any wrong assumptions, it could really change their financial picture. And of course, no corporate story is complete without a bit of legal drama. We see the companies wrestling with ongoing litigation, and as with any legal matter, it's tough to predict the impact, but there is a potential risk. So scroll to commitments and contingencies disclosure text block to review further. Also, if you scroll to fractional shares issued due to reverse stock split, notice the company did a reverse stock split in the past to stay listed on the stock exchange. Finally, it's always good to keep in mind that management is always trying to put on a positive spin to their business. If you are so inclined, you can scroll all the way up to the beginning to take a look at forward-looking statements. There is the typical disclaimer that actual results may be different than what the management predicts. Looking at the details, Cenntro seems to be a company in transition. Its attempt to cut back in areas like research and development might stabilize its financials, but it also risks falling behind in a very competitive EV landscape. It's positive to see they have a plan, especially as this is key to survive a tough market. What about this stock? Currently, I have no opinion on it. However, if you are interested in discussing this further, make sure to join our Discord to discuss it more. The link is in the description. Alright, that's our take on Cenntro's latest filing. What do you think? Are they heading in the right direction, or are these just temporary fixes? Let me know in the comments below, and if this analysis helped you make sense of it all, please hit that like button and subscribe for more deep dives. Thanks for watching, and I'll see you in the next one.